Hi everyone. It is Jeepers. What's today? Monday? Tuesday. It is Tuesday. It just blurs together, doesn't it? So Tuesday, the 19th of May 2020, and I, as part of the sort of Trading Skills 101, and I want to produce a series of videos that underscore the kind of the core competencies that traders must pay attention to, must be aware of, must make sure that they are aware of and are applying on a regular basis. And part of that, I thought I would start off this series, because it's a brand new series. I thought I would start off with framing what trading really is. And so trading is really a day-to-day activity. I think this is a very important distinction. So what I'm going to do here is just quickly write this up and just identify a couple of different things here. So I suppose I should have prepared a slide deck for this. But most importantly, what I want to say here is that trading is not investing. Okay, so this is really a very important distinction. Okay, so trading is really more concerned with a shorter term time frame. I'm interested. I've got to be earning. It's basically a monthly, a way to generate and earn a monthly income. Investing is generally approach to increase the value of our savings, right, over a much longer period of time. And so trading is an activity that takes place where the individual or ourselves as the trader, we are looking for money-making opportunities that similar to a day job, any type of day job, whether I'm an accountant or a lawyer or a waiter or an actor, anything that I do, I'm obviously looking to earn a monthly income. And so trading is the equivalent of that, whereas investing is more of an activity that a portion of my savings will go towards, ideally, towards my pension, towards my retirement, and that is much more of a longer term approach. So trading is more, what are my money-making opportunities today and this week versus money-making opportunities over the next 3 to 6 months, 2 to 5 years, 5 to 10 years or more. And that's an important distinction because timing is a factor, and we need to make sure that our entry and exit criteria and our criteria for taking money away from the market, exiting that position, is very important. So as a trader, that is an important rule. It's going to be part of our strategy. Is there's got to be a point at which we exit the market. All right, and we bank that money. Portion of that can then go into, we're not necessarily owning shares. We are usually employing CFD contracts with a broker, so contracts for daily, where we're looking to make an arrangement with a broker to enter a position for a period of time and then exit the position. Okay, so the reason I have to mention this is because the number of newer traders who confuse the two approaches then change their strategies, take away their stop loss, expose themselves to more risk, don't take profit when they're in profit. All of these ultimately contribute generally to negative results for newer traders. So it has to be emphasized right up front that as traders, we really cannot succeed unless we're actually taking profits from the market. That is predominantly our goal. So the point of this table is to illustrate the difference that it makes. So now that I've established what a trader is, then the next idea is that as a trader, we would look to risk a certain percentage of our capital per position that we have. Now, the general rule of thumb is 1 or 2% maximum risk per position. Okay, and that actually stems from very complex mathematics that have gone into calculating risk of ruin, which I believe originated from playing poker. So poker, if you have a strategy and you're trained, you should be aware of this, that you can effectively make more money than you lose playing poker. So it is a place where skill and education can lead in the longer run to earning a living from playing poker. That is an actual possibility where it's more of a strategy than it is pure gambling. So gambling by definition is usually going, depending on fate, to go our way rather than evidence, actual evidence to back up our decisions for exposing ourselves to risk in return for potential profit. And so trading is very much an evidence-based activity, okay? So it's not gambling. If it's done correctly, if it's done incorrectly, if there's no real evidence or reason, logical, rational reason to take the trade, then it's ironic because the gambling is defined by the trader, okay? Whether it's investing, whether it's I beg your pardon, whether it's a kind of a normal business approach or whether it's gambling. So 1 or 2% is usually, that came about as a result of mathematics, risk of ruin, which really defines that if we keep our exposure per position low enough, even if we have a losing streak around our strategy, the damage that we could do to our existing capital will always be recoverable. So in other words, we'll survive it and we'll be able to accumulate more from that. If we go beyond a certain, or if we go above a certain amount of risk per position, if we encounter a losing streak, the damage will be irreparable. And so we've settled on 1% as a universal kind of average amount per trade. So what do? Well, if I'm trading client funds, usually it'll be much lower. It'll be somewhere between 0.2 to 0.25%, a quarter or a fifth of a percent per position, because I'll usually be taking multiple positions. And so that is kind of my personal comfort zone. But in this case, what I wanted to do and demonstrate here is that if I risk an average of 1% per trade, and my strategy is generally accepted to yield an average of 3 times that. So if I find a strong setup that meets my strategy requirements, that strategy is likely, on average, it will have the potential to give me a 3-to-1 reward to risk. So there are different strategies out there. I'm looking for something that I can use on a regular basis. I'm looking to identify patterns in the market that will tend to unfold. So first of all, I want to find a pattern that occurs on a relatively regular basis. Then there'll be a way to identify if this is a strong version of that pattern that has a high probability of yielding profit. So in general, if my strategy is in a trend-based market, for example, then the likelihood of it yielding a greater than 1-to-1 reward to risk is higher. So my strategies currently are reasonably expected to yield an average return of 3-to-1. So that's how I've arrived at these 2 numbers here. And then what I've done is picked a sample size. So one of the other things that nails beginner traders is they think that a single trade will define who they are. Whereas a professional trader understands that they will be net profitable over a series of trades, because they are going to be in amongst every batch of trades they take, there will be losing trades. And if we knew which ones were going to be losing trades, we would just do that from the beginning, but we don't know that. So in this case, I've used 10 as my sample size, 1 as my percent risk per trade, and my reward to risk as 3. Sorry to be sort of rambling around this point, but I think it's important to place that foundation. So if I was a beginner trader and I managed to control myself emotionally so that I'm not exposing myself to undue risk or moving my stop loss or revenge trading, if I'm really genuinely have the basic grasp of my strategy and have identified an average setup, then here's an example of what I would expect a relatively healthy beginner trader to achieve. And I'm going to be very conservative here. 1 full win. And this is another thing. A lot of people out there, educators and professional traders, talk about winning and losing trades. But it is much more than that. And I'm going to demonstrate this to you now. It's much more complex than that. So I've got full wins on the left-hand side. I've got full losses on the right-hand side. So this would be a 3-to-1, at least a 3-to-1 reward to risk. And this would be obviously losing my 1% full losses. So if I'm a beginner trader and I get 1 properly winning trade out of these 10 trades, and maybe what I do is I get a couple where I manage to bank at least 1-to-1 out of that. So in other words, I've made 1% return on that. And then maybe what I do is I get a couple of trades where I move to break even. So in this case, what I'm going to do here is go 0 break evens, 0 partial losses, and maybe I get a couple of partial wins. In this particular case, I'm actually going to be down. Okay, so this is it's an average of that, basically, to give me an indication of that. And so I'm going to be down. And so naturally, out of 10 trades, 1 winning trade and a couple of partial wins. So the thing here is that the problem with this scenario, the 1 full win doesn't really demonstrate to me. First of all, I don't know whether that was a good trade setup or a bad trade setup, because you can take a bad trade and make profit. You can take a good trade and lose money. And so I'm not really sure yet at this time. Imagine I'm a beginner trader, so I'm not really sure what's going on there. Maybe my partial wins were 1% returns, for example. In this case, I've actually lowered it than that. So out of 2 partial wins, I really only made less than 1% profit. But the point is, I'm negative in that because the rest of my trades were losing trades, meaning that they hit my 1% loss. So here's where it gets really interesting. I'm just going to change these numbers here predominantly. I'm going to add a little bit here, but I'm going to show you the very subtle difference that comes from managing my trade. So I'll talk about that in a moment. So imagine that I'm a more experienced trader, that actually I'm generally consistently profitable, but I'm going to be conservative here. In this example, I am going to have 2 winning trades. In other words, 2 out of 10, and consider me in this case to be a good trader. Imagine that I only have 2 3-to-1 winning trades. Now, trades can obviously win more than that. They can be 5-to-1, 10-to-1, depending on the size of the market move. But what we have done here is we have reasonably allowed the market an average type of move. So in other words, we're not gambling here. We're looking for normal, reasonable moves in the marketplace. And so in this case, I've got 2 proper winning trades. Now, what I'm going to do here is also go, okay, I've got, in this example, 2 partial winning trades, which means they made whatever. In this case, it's obviously less than 1%, but let's just imagine they were 1-to-1s. This is where it gets interesting. Maybe I had 2 break-even trades, and maybe I had 1 where I managed to bring my stop loss a bit closer and I had a partial loss. So just through that, so through 2 proper winning trades, but predominantly reducing what I've done here is reduce my losses significantly. I've managed to move them to break even and partial losses and make partial wins. I've gone positive. And what I want you to take away from this is that the full wins haven't really changed much. I've gone from 1 to 2, but the partial wins, break-evens, and partial losses have completely made the difference. So partial wins are when I take some profit off the table as the market moves in my favor. So the way I do it is I take, in general, I'll take at least 50% profit off the table when the market hits my 1-to-1 target. Okay, that will often get me to break even. So in some of those situations, the market will go on and close out at 1-to-1, and in some of those situations the market will come back and hit my stop loss, which gives me break-even results. And then in some rare cases I might move my stop loss if I get a higher low in an uptrend, for example, and I can bring it up underneath that, or in a way in which I can I might even have hit my 1-to-1 target and now I'm at break-even, and I can move my stop loss up maybe closer to my entry, or I've found a way to do that. So there could be a reasonable explanation for that. And all I wanted to do is demonstrate to you how subtle the difference is. The magic is really in the trade management. Okay, so this is basing it on the fact that we have a strategy that is likely, that has a greater than 50% chance or 50% success rate. Okay, so what you have is your strategy needs to have, on average, what's called a 60% win ratio. Okay, which means that it wins approximately. Okay, that is reasonable to expect it to win 60% of the trades you take. Okay, so that's a reasonable expectation. Now, what's beautiful about this is as my experience grows, as I become more and more familiar with the types of setups, trade setups that my strategy gives the best results from, my selection criteria will improve. So with experience, that will actually improve and go to maybe could be 70 to 90% success rate, because my experience will get better. So that basically over time, the number of trades that will yield some profit will increase because of that win ratio. So this is a conservative starting point. Then it's not really, then of course what we have is your profit ratio. So the idea being that it will have something, for example, which is a 3-to-1 profit ratio, which basically means that it's a risk to reward. Okay, risk to reward is how much you make, how much profit you make when you win. How much profit, okay, when you win. And so this is the key. So this is what we generally want as a trader, is something with, I would think, reasonably a 60% win ratio, and ideally something, I did it again here, sorry, spell typos, a 3-to-1 profit ratio. Okay, so, and again, what is wrong with me? And then again, something like that. So we're looking for something that reasonably does that. And again, as I get more and more experienced, I might be able to squeeze a little bit out of it. But this aside, the management of my trades, when I go back to this, being able to take some profit off the table, try to get my trade to break even as possible. In other words, what I'm trying to do is reduce my losses, largely reduce my losses, and ideally allow the trade as much opportunity to hit its full potential. And you can see the difference. The difference is very subtle, and this would be per 10 trades. So that could be something that I take on as an intraday trader on the lower timeframes. It could be something that I take I could be a swing trader as well, trading end of day. And so the purpose of this video was to just put it in newer traders' minds that the difference between a profitable week or a profitable batch of trades, a big part of that is being able to take some profit off the table and understanding how our risk and our reward to risk ratio in the strategy does that, and that the results really come is a net profit from a batch of trades. So to understand that, if you can grasp that concept, you're more likely to then focus on mastering your strategy and keeping track of your trades so that you can work out if the strategy itself is delivering what it's supposed to be doing that. And it also gives you a sense of what we do as traders when we do that.